Hello Mavericks, this is Rob Reinhold. Welcome to Forex 101 Module 4, and in this session we're going to be going over FX correlations. Alright, we'll break that down here in just a second, but here's the one thing I really want you just to picture in your mind. Spiderwebs. Alright, there we go. I gave you a nice visual here for spiderwebs. And when I started trading, and when I started trading currencies, for those of you who don't know, I started trading in 1997, started trading currencies in 2006. I didn't understand a lot of the reasons why things were moving. I knew that they were moving, and I could see them moving, and I could follow trends, and I could follow support and resistance. But I didn't really understand the things that cause it to move. And I really learned that there are all of these strings tied onto financial assets. And there may not be any explanation at all why the financial asset you're looking at is moving. It might be because someone sneezed over in Germany. Now look, I know that sounds ridiculous, not sneeze, but something that happens in Germany, it actually can have an effect on an asset you're looking at all the way around the world. And that's because everything is tied together. And the biggest reason this has happened is because of computerized trading and algorithms. And so a lot of people have gone in and said, okay, when the price of gold does this, I'm going to sell this and buy this. So when you're looking at one of those assets, all of a sudden you see that the asset is going down, and you say, well, doesn't make any sense. Why is this asset moving down? There's no news on it. There's no anything. It might be because the price of gold did something, or it might be because something else did something. And so in this session, we're going to talk about a lot of the correlations that do happen, and some of the common correlations that when you understand these correlations, it's going to give you a lot of insight into what to do, where to watch, and what currencies to look for trades. Understand that the movement that you're going to watch on your screen probably doesn't have anything to do with like the euro. Now it might, we'll talk about that, but it might have to do about money flows out of the US. Maybe something unpopular happened in the United States and everyone is pulling their money out of the US and some of it's going over into Europe. So that's what we're talking about. These correlations, they cause things to move. And like I said, like a spider web, if you pull on one part of the spider web, it's going to move all the web. It's going to move everything here. So let's talk about correlations. Now there can be a positive and a negative correlation. So let's talk about these two things. So a positive correlation means that the two things you're looking at, and I should have started there. Whenever we're looking at a correlation, we're looking at how closely do two things behave to each other. So a score of 1 is what's called a perfect positive correlation. What this means is that these things move exactly the same. So for example, if I looked at the S&P 500 index, which the ticker symbol is SPX, and then I took a look at the SPY, which is the ETF that follows the SPX. Sadly, they do not have a 1 correlation. They have like a 0.99 correlation because they are basically the same thing. They're very, very positively correlated. And then if I was to come over here and take a look at something like the diamonds, which is the ETF for the Dow, and then I took a look at something like the dog, which is the inverse ETF of the Dow, these things would be negatively correlated. It means they move exactly opposite each other. So positive correlation means they move together. Negative correlation means they move opposite. Now this is something that took me a little bit of time to really figure out about correlations, because I thought, oh, and here it just means it's 50-50, right? Like if this is they're perfectly correlated together, and this means that they are totally negatively correlated, then in the middle just must mean, in the middle. No, it's not how correlations work. And the way I found this out was that there is a number called beta in the stock market. And beta is a measure of volatility. And what they've done is they've said, okay, the S&P 500 is the number one in volatility. So what it does is it compares the stock to the S&P 500. So if the number is 2 on the stock, the beta of the stock is 2, it means it's twice as volatile as the S&P 500. And if the number is 0.5, it means it's half as volatile. So that's always how I understood beta and correlations. And then I remember I was looking up Netflix. This is a long time ago, maybe back in 2009, 2010. And Netflix had a negative beta. And I was like, wait a second. If how I understood beta works, if the number's 2, it's twice as volatile. If it's 0.5, it's half as volatile. How in the world can something get negative? And this brought me into the world of statistics, where you have what's called an R value. And basically the R value is, it measures how correlated is it. And so over here, it's basically telling you it's perfectly correlated. Over here is telling you it's perfectly negatively correlated. In the middle, it means there's no correlation. Not that it's in the middle of perfect positive and perfect negative. That's not what it's saying. It's basically saying it's not correlated at all. So going back to the Netflix example, what it meant was that when the S&P went up, it went down. And when the S&P went down, it went up. So there was no correlation. You couldn't measure how volatile Netflix was compared to the S&P because it wasn't following the S&P at all. Now, most stocks are positively correlated with the S&P 500. There are a few stocks out there that are negatively correlated with the S&P 500, but at that moment, Netflix had no correlation. It was doing its own thing, and the overall market had no bearing on it. So I wanted to get that out there so you really understood. In the middle here, correlation 0 means there's nothing to be seen here. There's no data. They don't follow each other at all. It's not that they're negatively correlated, they're just not correlated at all. So let's take a look at just a couple of stock examples for correlation. So here is an example of positive correlation. So on the left we have Goldman Sachs, and on the right we have Morgan Stanley. They're both in the brokerage business, wealth services business, trading business, asset management business. So they are fairly similar companies, and you can see they move roughly together. When Goldman Sachs was running, Morgan Stanley was running. Morgan Stanley went sideways, Goldman Sachs went sideways. You can see there's differences. But when they ran again, they ran together, and when they fell together. So you can see here, these are fairly positively, they're not perfectly positively correlated, but they are positively correlated. And then if we take a look at the next example, here's an example of a negative correlation. So this ticker symbol FAS, when it was running, FAZ was falling. You see they moved together here, but then FAS went up, this one went down, and you can see they're inversely or negatively correlated. Now this makes sense because this is the financial ETF times 3 to the upside, and this is the financial ETF times 3 to the downside. So these are going to be pretty close to perfectly negatively correlated. But that's how these correlations work. There's either positive or negative correlations that we're dealing with. Now you've probably all heard the saying, correlation doesn't equal causation. Now what that is saying is, just because things are correlated doesn't mean that they cause each other to happen. Well, guess what? I am not going to say that in this session because literally correlation equals causation. We're going to talk about all of the causes that cause these correlations. So you're not going to hear me say that in this session here. We're going to take a look at 3 correlations. We're going to take a look at number 1, market correlations. These market correlations are probably the strongest correlations in the currency marketplace. These are the ones that cause probably the biggest and most impact on whatever currency you're looking at. We're also going to take a look at commodity correlations. Certain commodities control certain currencies. We're going to look at those, we're going to talk about those. And then there's also currency correlations, meaning when one goes up, one goes down. There are things there where, for example, if the yen goes up, what it means is another currency is likely going to go down because they are negatively correlated. So we're going to talk about which currencies are actually correlated together and which ones are negatively correlated. And we're going to spend the most amount of time on market correlations because these are definitely going to be the most important. And the place we need to start out, which is just the basics of investing, just the basics of what people do. Now, when you take economics, probably in the junior high or high school level, now I'm saying that, but we did not have economics in school when I was in there. Yeah, I know, I'm old, I get it. My kids had it. But this is really the basics of economics. It's a measure between risk and reward. And so there are some assets that are deemed very safe. And there are some assets that are deemed to be risky. And it's a matter of volatility and the risk of loss. So if there's a greater likelihood of you having a large loss, that's considered more risky. So there are some investments out there that are considered quite safe, like let's take U.S. government bonds. The U.S. government bonds are considered one of the safest assets in the world. They are paid by the U.S. government, they are guaranteed by the U.S. government, and they usually carry somewhere between I've got to widen this out now, somewhere between a 3 and 10% return on a 30-year bond. I never thought I'd be able to say it got down to 3, but it's been down at 3 for a while here. Now again, that money is guaranteed. There is no risk of loss unless the U.S. government goes out of business. That's the risk of loss. If it doesn't go out of business, it's guaranteed. You will get your 3%, your 5% every year until the term runs out. Then you'll get your money that you paid for the bond back. Stocks, on the other hand, we've seen what stocks can do. Stocks can run up 30, 40%. They can crash 30, 40%. They're considered more risky. So there is this allocation or this little game between stocks and bonds. And bonds have a much higher percentage return when things are good and a much lower percentage return when things are bad. So what happens is people play with this risky to less risky assets. So when economies are doing very well, people invest in stocks and they don't invest in bonds. So what happens is the value of stocks go higher and the value of bonds go lower. But once there is something to be worried about, people are scared. People will sell their risky assets and they will pile their money into safe assets. They'll put them into bank deposits. They'll put them into bonds. They'll put them into, again, utility stocks. Things are considered to be less risky. This is the major underlying concept of why assets go up in value, is where people are looking to place their money and their investments. And this is a very, very strong thing in the currency market. So let's just take a little example here. So I imagine you all have heard of the coronavirus. Yes, you've probably heard of it. Anyway, when it hit, economy shut down. And we had 25% losses in GDP. And this is the Japanese yen. Now during that time, the Japanese yen soared. It soared 11.6% in 4 weeks. That is a huge move in currencies. I mean, that is such a huge move in currencies. We're lucky if we get a 0.5% move in a week on a currency. But you can see for 4 weeks, we had an 11.5% move. That is just a giant move. Why? Why did the yen move so much higher? Because people bought the yen. Why did they buy the yen? Well, they bought the yen because it's considered one of those safer investments to go to. There was a risk-off move, and you're going to hear these terms all the time from us, risk on and risk off. And risk off means that people are looking to buy safe investments. So in the world of currencies, when we see a risk-off move means that people are looking to exit what are considered riskier assets and to buy what's considered safer assets. Well, remember, anytime there is a conversion of currency, it affects currency prices. So what is the one thing that people really probably want to buy in times of strife? It's probably U.S. government bonds. U.S. government bonds are deemed one of the safest investments out there. So money will come out of the rest of the world and go into the U.S. to buy U.S. government bonds. It'll also just flat out buy the U.S. dollar currency. Japanese bonds, it's called JGBs, are also deemed one of the safest investments you can have out there. Again, the reason is because, remember, they're backed by the full faith of the governments. The United States has the largest economy in the world. China has the second largest, and Japan has the third largest. So basically what they're saying is, okay, they're the biggest kids on the block. If the whole world goes to, you know what, these are probably going to be the last countries left standing because they're the biggest ones on the block. Again, a country like Australia might not have the kind of reserves to be able to pay off all their bonds. They may not have enough wealth and enough built up, and that's what the worry is about. So traditionally speaking, the yen, the US dollar, and the Swiss franc are considered currencies of safety. And what are considered risky currencies are going to be all the ones in the red: the New Zealand dollar, the Australian dollar, and the Canadian dollar. So this is a very classic risk-off move. So if the stock markets around the world and the economies around the world start to decline, what we've seen in the past is that these currencies go up, and the growth currencies, we call them the growth currencies, the Kiwi, Aussie, and CAD, will go down in value. We see just the opposite when we have a risk on. Now, risk on is when, okay, people are optimistic, economies are growing, people are buying stocks, they're buying risky assets. Well, these are the currencies that tend to do well in this risk on situation. The Kiwi, the Aussie, and the Canadian dollar, we call these the growth currencies because typically their economies are much smaller, so they can achieve much higher growth rates during times of prosperity. And what usually struggle during that period of time? The dollar, the yen, and the franc. All right, so we covered 6 out of the 8 that we're going to be talking about. Let's talk about the euro and the pound. They're kind of in the middle. They're kind of in the middle where on a very classic risk-on move, you will see the Aussie, the Kiwi, and the CAD as the best performers, the dollar, the yen, the Swiss franc as the worst, and typically you'll see the euro and the pound in the middle, to where, hey, they weren't the best, weren't the worst, they were somewhere in the middle. Now again, this is what we talk about when we say the classic risk on, classic risk off. Here is the point though. It doesn't always happen like it is in textbooks. I always tell people, when you learn about trading, it's just like when you went to college and you took classes about business and then you started in business and you realize, oh, this didn't prepare me at all. That's not how it is in the books. Trading is the same way. This is the book. This is what the book says. The book says this is what's supposed to happen. The thing is, it doesn't always happen like this. And a lot of times we have changes. And so this is something that we are always talking about. So in all of our FX rooms and all of our midweek FX rooms on Wednesday, we're always discussing what is acting as a risk on and risk off currency. And we talk about, hey, this is acting, usually this doesn't act very well, but it's actually acting very well. So we have to be dialed into these changes. So here's just one example of how things can change. As I talked about, the euro was usually in the middle, right? And the franc was usually a currency of strength when the markets have some panic. Well, if you go all the way back to 2012, 2013, this is where the Eurozone was on the verge of collapse. The Eurozone was a new experiment that had never been done in human history. Can we take different countries with different cultures and with different economies and have them come together and share one currency? Now, in the past, every country's had its own currency, so when one country gets weak, when one country falls behind, what happens is their currency goes down in value, which then makes it easier for them to export their goods and services to other countries because it's cheaper. They can do it for cheaper now. And what it does is it gives them an advantage. So if you have a strong player like Germany, and then you have a weak player like Greece, at some point Greece's currency, which used to be the drachma, would have weakened so much that Greek goods now started to look more attractive than German goods because of the price, because the currency value made it so much more attractive. Well, in 1998, they all came together as one block. And what happened was exactly what I just said. Germany, France, some of the northern European countries, they were doing very, very well. They were contributing all their money to the Eurozone. They were keeping, their banks perfectly deposited. And then there were some countries that lagged behind. Their economies didn't perform that well. They had structural problems. And pretty soon, all the strong countries were saying, hey, we don't want the weak countries anymore. However, there was no mechanism built into the Eurozone agreement. So everyone's like, what's going to happen? If this whole thing breaks, what is going to happen? And so a lot of people said, I don't want to own euros. If that happens, I don't want to own euros because I don't even know what a euro will be worth. If all of these countries break apart, how in the world will I know what this currency is actually worth? So what we saw during that period of time is we saw the euro become the riskiest currency. And so when the financial markets started to fall because of this worry, the euro was the weakest because it was deemed the riskiest. Now the Swiss franc, which is usually a currency of safety, they are right in the middle of the eurozone. And frankly, people were worried about what would happen to Switzerland as well. So all of a sudden, the Swiss franc fell out of favor from being a risk on or a risk off currency. And so the money had to go elsewhere. So people looked around the world and they said, well, hey, New Zealand's actually doing pretty good. So all of a sudden, New Zealand started to act a little bit like a currency of safety because as money was leaving the Eurozone, leaving Switzerland, it was looking for places to go. And people said, hey, look, I think New Zealand is a good place to go. I wanted to go through that whole story just so you can see how this is going to change throughout your trading career and how stories and news are going to make this different. And there's going to be some times where, again, the dollar is usually a currency of safety. There's going to be some times where it's not. And then again, this is where we're always talking with our traders. We're always talking about risk on, risk off, currencies of safety, because we want to be as close to where the market is on this as possible. Because this is a huge correlation. If equity markets are going down, and you know what currencies are acting as currencies of safety, you already know one of the currencies you want to pair it up with when you make a trade. Let's move next into commodity correlations. We're going to start off with Canada. All right, so Canada, they are a resource-rich economy. And what I mean by that is that a large percentage of their economy is based on their resources. All right, so if that's the case, then the price of resources is very, very important to the country. Now, back in 2005, if you remember, when the price of oil went all the way up to $150 a barrel, and then all of a sudden it crashed all the way back down to 30, and then it ran all the way back up to 80. This has been tough for Canada because there's been some times where they've had to completely shut down oil production. Now, if they shut down oil production, that means there's a lot of people out of work. And if there's a lot of people out of work, that means higher unemployment. And if there's higher unemployment, it means the government is collecting less taxes. And all of a sudden, the bonds the government sold are a lot more risky. So people look to leave that kind of risk. So when we take a look at commodity correlations, we really have to understand the economies that we're dealing with. And so we're going to go through commodity correlations. There's really just a few I want to talk about, and then I don't want to get too far out into left field talking about cocoa prices and its correlation with, I don't even know what would be correlation with cocoa, so we're definitely not even going to go there. But here's a correlation you're going to see all the time. Canadian dollar versus the price of oil. So as you can see here, we've got pretty high correlations here. You can see when they move together. When there's big sharp moves down, they move together. There's a pretty high correlation with oil and CAD. However, remember, this is in general. Let's take we'll look back all the way to January 1986 through 1991. At this point, the price of oil went up substantially. The value of the Canadian dollar did not change whatsoever. So understand that these correlations, they don't always happen. And you'll hear us say that on the FX rooms all the time, that, hey, you know what, the correlation's not there, so don't look for it if it's not there right now. Let's take a look at some other correlations. There's a big correlation in the gold market. So with gold, we have three currencies that are pretty highly correlated to the price of gold. One is the Swiss franc. Now, why is that? Well, the Swiss franc is the only currency that is still pegged to the gold standard. I'm not going to talk about it in this video. We have other videos that talk about the gold standard. But basically, their currency is actually still backed by physical gold. And so what that means is that when the Swiss government wants to make more money, they must acquire more gold. So if your country just bought up a whole bunch of gold, and then the price of gold went up substantially, your country just got a whole lot richer and is much more likely to be able to pay out on its bonds. So the bonds become safer, so people want to buy those bonds, which means they're exchanging currencies for your country. So the Swiss franc holds a lot of gold. Australia mines a lot of gold. That's one of their biggest resources, and one of their business industries is mining. So mining has an oversized effect on the Australian dollar. And I put the Kiwi on there because the Kiwi is highly correlated to the Australian dollar. That's a currency conversion. We're going to talk about that next. So the fact that if the Aussie dollar goes up because of the price of gold, the Kiwi is going to go with it, and vice versa. If the price of gold goes down, the Aussie dollar typically goes down along with the franc, and because the Aussie is highly correlated with the Kiwi, it usually drags that Kiwi down as well. All right, so how do we know what correlations? Now, we just went through some easy ones. We just talked about oil with the CAD. We talked about gold with the Aussie and the franc. There are other commodity currencies out there, but we don't typically trade them. Like the South African rand is also highly correlated to the price of gold. The Swedish krona is also, and Norway's currency is also tied to oil quite a bit. But for the most part, these are the major correlations. And again, it's why we look at the price of oil on every FX room. We take a look at the price of oil, and we take a look at the price of gold. We take a look at those two because it's going to tell us a little bit about what's happening in the CAD, the Aussie, and the Swiss franc. All right, now if you are really interested, there are some websites out there. I'm going to give you this one, Pax Forex. You can go out and it will actually show you what is the correlation. So again, if you can see here, I know it's not the cleanest chart here. This is the best one I could get. But let's take copper. Is copper correlated to the euro? And it's giving us plus 0.43. It's mildly correlated. Obviously, we're going to look at the stuff in the green. That's going to be the highest correlations. So oil and copper are correlated. You can see there's not really anything highly correlated with copper here. But again, there are these charts out there that you can go through and you can see, okay, what is highly correlated with the euro? We got some correlation of oil, barely with sugar, palladium. Again, we got a correlation with dollar yen here. All right, so these are out there. Let me give you some advice. Don't spend a ton of time on these because the big ones, oil and gold, that's going to be the major ones you need to know. And you can pretty much forget about all the rest. Lastly, let's cover currency correlations. Now, we already talked about one of the currency correlations, I mentioned that the Australian dollar is highly correlated, positively correlated to the Kiwi, to the New Zealand dollar. Why? Because they're very close to each other. And so they most likely have the most amount of trade to do with each other. So I know this is groundbreaking, but the countries closest to other countries are typically your biggest trading partner. Wow, that's amazing, isn't it? No, it's not amazing. It's geography. And so again, the United States and Canada are very large trading partners. So if there is some real serious problem in the United States, that's probably going to negatively affect Canada. That just makes some sense. And so we get these correlations between the two. So again, Australia and New Zealand are the biggest trading partners together. Outside of them, their biggest trading partners, both of them, are China. China is a very big part of their gross domestic product and is their largest exporter. So if there are problems in China, then you have to assume that it is going to negatively affect Australia and New Zealand. And so sure enough, whatever happens in China is actually outsized more important to Australia and New Zealand, and you're going to see those correlations between the two. In this example, we're talking about the Eurozone. So let's say that the Eurozone had some good news. Well, I'll give you some good news. The Eurozone in the coronavirus outbreak, they shut down very hard, and they were very severe, and they took a very methodical approach to it. Yes, we had some problems in Italy and Spain early on, but they went and they crushed it, and they were very, very draconian, and they basically shut everything down, and everyone was compliant. And their coronavirus cases went away very quickly. Now, when they did that, they crushed their economy. They killed it. But when it was all over, they came out of it very strongly. Over in the United States didn't follow as closely as it did in the Eurozone, and the cases in the United States kept rising and rising and rising and rising. And so the United States economy stayed partially shut down for months and months and months. But then the European economies actually could open up much more. So there's an example of a story that could hit. And if the Eurozone comes out of the coronavirus shutdown a lot stronger position, it's going to help its neighbors. So it's going to help the Swiss franc, it's going to help the UK, and you can see that these are all going to be positively correlated. They're all going to move together as a group. So we see all these positive and negative correlations out there. We talk all the time about many times the euro and the dollar are negatively correlated. If one is going up, the other is going down, and vice versa. So you'll learn more of these currency correlations, but if you want to learn more of them, just go on to the maverickfx.com members area, go to tools, and in those tools things there is a currency correlations page there. You can go in and see these scores. So we just talked about these scores. So let's take a look at euro dollar against pound dollar. So again, we're really now comparing euro to pound because this is if A equals B and B equals C, then A equals C, right? Remember that? I can't remember what theory that was. I think it's a transitive. Anyway, so we're saying, okay, euro dollar compared to pound dollar, there's an 89.2. 100 is the highest. It was just basically number one. So the euro and pound are correlated 0.89. That's a very, very positive correlation. The Swiss franc, again, is comparing it to the dollar Swiss franc, so it flips it around. There's a 92% correlation with the Swiss franc. So we can look through them and say, okay, well, over the past, again, this is a daily period, the euro has been highly correlated with the pound and with the Swiss franc. And look at this, it's also been highly correlated with the Aussie, a 93% correlation. So now it's telling us, hey, if you're really serious about euro, you may want to take a look at Aussie because it seems like they're moving together. Now, I actually promise you I was going to say correlation doesn't always equal causation. And I'm actually going to say it because it might be just that the euro and Aussie are moving together at the moment. One is not causing the other. But this is just where you can go quickly and you can say, okay, I want to see what is correlated right now. I want to see Aussie. What's Aussie correlated with right now? And you can see what it's highly correlated with across the board. So again, you'll learn these over time. If you want to jump on the chart, great. It breaks it down into different time frames. You want to see what's been the most correlated today. Great. It's right there. What's been the most correlated over the past 4 hours. It's right there. So you're going to learn these correlations. But again, if you just show up with us on every Sunday or watch videos, we go through this all the time. These are correlated together. These are really moving together right now. All right, so let's wrap this up. Here's all these market correlations. So as you can see here, we didn't talk about any currency specifically. We didn't get into the euro and talk about the ECB and what was happening in the euro. We didn't talk about that at all. We talked about what equity markets are doing. Is it risk on or risk off? We talked about commodities and we talked about currency correlations with other currencies. We didn't talk about a chart. We haven't talked about anything. But let me tell you when you're going to find your best trades. It's when you get all of these with the wind at your back. So I want to walk you through the perfect correlation setup to really get in your mind what it is you're looking for. All right, so we look at the stock markets around the world and they're going higher. It's a risk-on environment. So we're thinking to ourselves, okay, what is a risk-on currency? And we say, you know what, the Aussie is likely a risk-on currency. Then we go in and we see that gold is also running higher. And then we say, oh, you know what, I remember. Aussie has a high correlation with the price of gold. And then we also notice that the Kiwi is running higher as well. And we also know that the Aussie and Kiwi have a high correlation together. As you get to see, all three of these elevators are going the right way. And really, I want to really use the phrase wind at your back. The wind's at your back. You've got all of the correlations are going to pull the Aussie in a certain direction. Now look, that doesn't mean the Aussie has to go up. Sometimes it doesn't. But what I'm saying is you've got all the wind at your back. These are going to be the best setups you can find when you get all these correlations and then you get a great looking chart on the Aussie paired up against maybe like the dollar or the yen. This is where your best trades are going to come from. Is when you can get all these correlations in addition to a great looking chart setup. All right, well, thanks for joining me. Hopefully, again, understand how much currency movements are due to other factors. There's a lot of spiderwebs out there, a lot of things happening. And I remember when I was a young trader, I used to yell at my screen, why are you going up? Why is it going up? I would literally yell at it. I stopped yelling at it because it never answered me back. It never did. And I had to realize, like, oh, I'll never know why this is happening. There's going to be sometimes you never know why a trade is going one way or the other. It could be, like I said, someone sneezed in Germany. There's been stories of fat fingers where a trader put on one too many zeros onto a trade and it caused a massive ripple effect. That's going to happen. Focus on the market forces, risk on, risk off. That's the most powerful one you can learn. Risk on, risk off. And then commodities, learn which they're tied to. And then, of course, other currencies, learn which currencies are tied together. It's really, really going to help you out. All right, thanks for joining. That is FX Correlations. Goodbye.